Good afternoon, everyone, and welcome to our third webinar today in our series. My name is Danny, and I'm with the learning team at Cherry Beckert. Just want to go over a few quick housekeeping items before we get started. For audio during today's webinar, you may listen through the phone or the computer speaker. You can choose your audio under the Audio tab in the menu to the right of your screen. To earn CPE for today's webinar, please make sure you answer all the polling questions. Make sure you click the Submit button to submit your answers. Instructors will try to remind you of this as each poll appears. We will be distributing CPE certificates via email in the coming weeks. The instructors and I will answer questions in the question and answer pod. We will try to answer them throughout the webinar. So that's all for the housekeeping announcements, and I will turn it over to Matthew.
Thank you once again, Danny, and welcome everyone back to the second to last session in our not-for-profit seminar. And very lucky to be joined by Amanda Adams for this not-for-profit tax update. For those of you who do not know Amanda is the national leader of Cherry Beckert's not-for-profit tax practice, and she oversees the tax compliance services and consulting matters for all of the firm's tax-exempt organization clients. She also is regularly talking about industry trends in presentations like this one, and I can attest that she is very regularly monitoring all legislative and regulatory developments, some of which we'll be talking about on today's session as well. So Amanda, thank you so much for joining us, and I will turn it over to you for the update.
All right, thanks Matthew, and thanks everybody for joining us this afternoon. As if we didn't have enough to deal with a pandemic and everything going on, we had a lot of implementation relating to the Tax Cuts and Jobs Act, as well as the CARES Act had tax implications as well, that I know a lot of you were trying to understand and digest and figure out how they affected your organization. So today, what we're going to talk about is the Tax Cuts and Jobs Act provisions. So some guidance has come out during the year to help us implement those provisions. And then we're also going to talk about the IRS's compliance program and accomplishments. So every year the IRS puts out a newsletter talking about sort of the things that they did over the past year, and also lets us know kind of where they're going in the upcoming year. What are they going to be looking at with respect to exempt organizations? And then there have been some other developments, other requirements during the year that we're going to touch on as well. So first, I'm sure you're aware, but we all heard the good news last year about the repeal of the tax on providing parking to employees. Fortunately, this was retroactively repealed, which means that any organization that did report taxable income related to parking for employees was eligible to receive a refund. Unfortunately, the IRS did not provide a streamlined way of getting the tax paid back. So really the only process was for organizations that had filed a 990T to report the tax to file an amended 990T to request a refund. As you probably know, the IRS, like many organizations, was shut down starting in April as part of the pandemic issues that we all faced. Their offices were shut down for several months, meaning that any items such as a Form 990T that were filed on paper kind of piled up in the office. And by some estimates, they had at one point about 18 million pieces of unopened mail to go through. So many of you that filed an amended 990T sometime during the summer may still be waiting to get that refund. So processing times are pretty delayed. Another good piece of information that came out has to do with the requirement for organizations to track their unrelated business income by trade or business activity. So by way of background, the Tax Cuts and Jobs Act added this new requirement. And so organizations that have more than one trade or business activity beginning with the 2018 tax year were required to track the income and expenses by activity separately and report them separately on Form 990T. So notice 2018-67 provided some transition rules and interim guidance, and then proposed regulations were issued in April. Well, the IRS is moving pretty quickly on this, as the final regulations were issued just recently in November. So the final regulations are fairly similar to the proposed regulations, but we're going to talk a little bit about the differences. So the main concepts as provided in the final regulations are essentially that income is going to be broken out into kind of three main categories. There'll be investment activities, which includes income from qualifying partnership and S corporation interests, and also includes income from debt financed property. So all of the income from those interests or activities will be grouped together in one category called investing activities. For any non-investment activities, an organization is required to use the 2-digit NAICS code to define the activity. And then if an organization has multiple activities that are described using the same 2-digit NAICS code, then they'll be grouped together under that 2-digit code. And then the last main category has to do with unrelated business income that stems from a payment from a controlled entity that's in the nature of a specified payment, which would include like rent, interest, royalties, etc. So for those types of income, the IRS provided in the regulations that will be tracked separately by entity, basically going off of the theory that the entity that made the payment is operating its own trade or business activity, and therefore it should be treated as a separate activity. There had been some comments on the regulations suggesting that all payments of that character should be aggregated together, but the IRS didn't accept that approach, saying that those entities could be engaged in different trade or business activities. So partnership interests, there's a lot of guidance around this. So we're going to spend the next few slides kind of going through the different exceptions and things that would need to be taken into account. But let's start with just sort of the general rule, and that kind of will help us understand sort of the exceptions and the special rules. So when an organization is invested in a partnership, the activities of the partnership are attributed to the organization as a partner. It doesn't matter that the organization as a partner isn't engaged in any of those activities directly, they're still deemed to have the same character in the hands of the partner. So the general rule would be that a partner would have to look at the unrelated business income coming from the partnership in terms of each activity that is conducted by the partnership. So you can imagine that there would be potential partnership interests that could be engaged in hundreds, if not thousands, of different types of activities, because they might be invested in a lot of different funds that would be engaged in activities. So there are two exceptions that are provided for investment activities, which will allow an organization to aggregate all of the UBTI from its partnership interests. So not only the UBTI within a single partnership interest that might represent multiple trade or business activities, but also income from multiple partnership investments. So the main thing is, number one, the organization cannot be a general partner in the partnership. It would need to be a limited partner. And then it would also need to meet either the de minimis test, which means that the organization owns no more than 2% of the partnership interest, or it can meet what's called the participation test, which would allow for a percentage of up to 20% when taking into account ownership of certain related entities. And then there are also some additional factors. So this is one of the items that changed from the proposed regulations. If you were familiar with those, this is what was called the control test in the proposed regulation. And so the IRS got a lot of comments about the control test, and basically they were focused on the fact that 20% did not seem like a substantial enough ownership percentage to establish control. And so I think that's why they changed the name of the test, because essentially they're providing this as just an administrative convenience. So they didn't want people to get hung up on the idea that if they didn't control the partnership, that they shouldn't not meet the test. So essentially, the idea is that now we're talking about participation. And so the idea of meeting the test is that you're saying that the organization does not significantly participate in the activities of the partnership. And that's evidenced by not only the ownership percentage, but also some additional factors that we'll go through in just a minute. So the last item that an organization could avail itself of temporarily is the transition rule. So this is for partnerships that were acquired prior to August 21st, 2018, and that do not meet the de minimis test or the participation test. So for those, what an organization can choose to do is to treat that particular partnership interest as its own trade or business activity. So you wouldn't need to look through the partnership to see what kinds of activities it's conducting. You would just treat that partnership interest as one trade or business. So one issue with that is that the rule is not a grandfather rule. It is going to sunset. So if you're following that approach for a partnership, you will only be able to do so until the organization's first tax year beginning after December 2nd, 2020. So the de minimis test, as I mentioned before, the organization has to own 2% or less of the profits interest and 2% or less of the capital interest. And if that's the case, then it will be considered a qualified partnership interest that can be combined with other qualified partnership interests for purposes of reporting. So the participation test is 20% or less of the capital interest, including the interests of related organizations, and the organization cannot significantly participate in the partnership. If both of those pieces are met, then it will be a qualified partnership interest that can be aggregated. So the definition of related interest changed a little bit over the course of the notice and the proposed regulations. And so it's positive in that the final regulations only include the following organizations as related interests: interests of a type 1 or type 2 supporting organization, or a type 3 supporting organization, which is a parent of its supported organization. So typically type 3 supporting organizations have the least amount of control by the supported organization. So this makes sense that they would only go with the supporting organization types that evidence significant control, either as a parent-child relationship or brother-sister relationship. And then any interests of a controlled entity, which is defined as under the same rules as 512b13, which would essentially mean either ownership of more than 50% of the entity, or similar to a type 1 supporting organization, appointment of a majority of the board of the organization if it's a nonprofit. So again, it's important to define related interests that may potentially also own the same type of partnership investment for purposes of qualifying under the participation test. So then the sort of second layer beyond just the ownership percentage is determining whether the organization significantly participates in the partnership. And the regulations boil this down to the following factors. If the organization by itself can require the partnership to or prevent it from performing any act that significantly affects the partnership's operations, or if any of the organization's governing body or employees have the right to participate in the management of the partnership or conduct the partnership's business at any time, or if the organization by itself has the power to appoint or remove any of the partnership's officers or employees or a majority of the directors. If any of those factors are present, then the organization will be deemed to significantly participate in the partnership, and therefore it can't be treated as a qualified partnership interest. So it's important you notice the language by itself is there in a couple of the factors, and that came as a result of some comments on the proposed regulations where they were concerned that if there were certain items that required a unanimous vote by the partners, that they would fail this test. So if one of these factors is based on a unanimous vote, but the organization by itself would not have the power, but only as, being part of a dissenting vote, then it would not need to be taken into account for this test. So another complicated rule is the look-through rule, but I think it can have benefits for some organizations in that if you own a partnership interest that doesn't qualify as a qualified partnership interest, meaning it doesn't meet the de minimis test or the participation test, what you can do is sort of look through that partnership interest to any sort of indirectly held partnership interests. And if those indirectly held partnership interests meet either the de minimis test or the participation test, then those indirectly held interests can be treated as qualified partnership interests. So I know what a lot of you who are familiar with K1s are probably saying to yourself, how on earth are we even going to get the information to be able to determine this? I totally agree with you. I imagine that this may likely only come up in situations where the exempt organization is holds a large percentage and therefore has a lot of information and insight into the underlying activities. But in the event that the organization is able to get this information, it could lead to a favorable result. So I've got an example here that shows actually how far down this could go. So if we have an organization owning 50% of partnership A, and partnership A owns 4% of lower tier partnership B, and 70% of lower tier partnership C. Partnership C then owns 50% of lower tier partnership D. The organization is able to treat its indirectly held interests in B, which is a 2% ownership, and D, 17.5% ownership, assuming that the participation test is fully met, then those two partnership interests could be treated as QPIs, but not partnership C, which would have a 35% ownership. So again, you would have to be able to determine the underlying ownership percentages as well as the UBTI related to each of those partnership interests in order to actually avail yourself of this rule. The other thing to remember is that you can't use both the transition rule and the look-through rule. So if you are using the transition rule, meaning that you're treating a partnership interest that you owned in August of 2018 as its own standalone business, then you can't also look through to see what that partnership owns and treat indirectly held partnership interests as QPIs. It's one or the other. So once you've committed to using the transition rule, you've got to continue until that rule is no longer available. All right, so that brings us to poll question number 1, which is, has your organization been impacted by the new requirement to track UBTI separately for each trade or business? All right, so we've got about 83%. Oh, that number's going up. So everyone make sure to get your vote in and close it. And with about 94% voting, the majority of you are not really affected. So that's good news. The rules are very complicated. So I'm glad to hear that a lot of people have not been significantly affected. I know that the IRS is trying to, potentially increase the tax revenues that it's collecting from unrelated trade or business income by all of these efforts. So it may be that they're not as successful as they had hoped. All right, so continuing on, S corporation interests are treated similarly to partnership interests, except that if they are not qualifying S corporation interests using the same rules as those for partnership interests, then each interest will be treated as a separate, unrelated trade or business. So there's no real look through in terms of needing to know what the multiple businesses that an S corporation might be involved in. It's just automatically treated as a separate trade or business. So calculating ownership percentage, it's based on an average of the organization's percentage interest at the beginning and the end of the partnership's tax year, ending within the organization's year. And so if it's not been owned for the entire year, then essentially you take an average of the ownership interest held at the beginning of ownership and end of the period of ownership within the partnership's tax year. And you can rely on the Schedule K-1 that you receive unless it just puts various instead of the actual ownership percentage. So moving on to the second big category of tracking unrelated business income separately is the use of NAICS codes. So Notice 2018-67 had talked about potentially using 6-digit codes, 4-digit codes, 3-digit codes. So I think we're very fortunate in that the final regulations, although they ultimately decided to go with NAICS codes instead of some kind of a facts and circumstances approach, that they did go with the broadest categories possible, which is the 2-digit codes. So each 2-digit code will be reported only once, but since the 2-digit codes are kind of vague, the regulations provide that you should determine your separate trade or business activities based on the 6-digit code, which is more specific. But then to the extent that you have multiple 6-digit codes that would be described in the 2-digit code, you would combine those. So like, for example, the operation of a parking lot is 6-digit code 812930. So that would fall under the 2-digit code 81, which has the broad category name of other services. So it wouldn't really be obvious from that, where the parking operation should go. So if the organization changes the code reported for a specific activity, it has to report information about the change on Form 990T for the year of the change. And so this is just kind of an example. You can see these are the sort of the broad categories that will be used in terms of reporting any unrelated business income that's not covered by the investment activity or income from controlled entities. So a really important unanswered question from the regulations has to do with expense allocations. So this is a project the IRS has been working on for a number of years. There was a famous case, Rensselaer Polytechnic Institute, and it's an old case, but it dealt the IRS kind of a blow that it hasn't yet been able to recover from. And that's with respect to expense allocations. So Rensselaer is a college that was operating a field house that was used for exempt purposes as well as generating unrelated trade or business income. And in calculating their unrelated business taxable income and determining their allocation of expenses, they based it on the actual use of the field house. So because there were times during the year where the weather was not good or it just was not used for either exempt or an unrelated purpose, they essentially tracked the number of hours in which it was used for either purpose, and then of course tracked the hours used in each individual purpose and allocated the expenses that way. So the IRS challenged it, and they wanted them to base the expense allocations on hours of available use, but the courts did not accept that argument. So in the action on decision relating to this case, the IRS stated that they would not litigate the reasonableness of an allocation method until the allocation rules were amended, and they still have not fully been, except for one piece that is addressed in the regulations under 512. And so the concern is they want to move away from the sort of facts and circumstances, reasonableness approach, and they want very sort of bright line guidelines that will explain what is permissible and what isn't, not only to provide clarity to exempt organizations trying to make the calculations, but also clarity in the IRS in enforcing them. So they're still working on this guidance. They hope to have it out in the future, hopefully the near future. But they did provide in these final regulations that an allocation method that fails to equalize price differences between related and unrelated activities will not be deemed a reasonable approach to allocating expenses. And so this is otherwise known as the unadjusted gross to gross method. So if an organization is following that method, it will no longer be considered reasonable and the IRS could challenge it. So essentially where this could come up is if, for example, an organization has a golf course and they provide the golf course for use for students at a reduced price, and then they allow members of the general public to come and use it at a higher price. If you want to use sort of the comparative revenue to allocate the related expenses, then you would have to take into account the fact that the sort of related student usage has a different price than the unrelated sort of public usage, because if you don't, then essentially you'll be over allocating expenses to the unrelated activity just because the revenue is more. The other thing that the regulations brought sort of confirmed is that all deductions other than the charitable contribution deduction have to be allocated to each separate trade or business activity separately. So there were some comments about, well, how do we allocate state tax expenses or accounting fees that kind of just relate to everything as a whole? And the IRS rejected the argument that there was any need to deduct those from net unrelated business taxable income, and instead the only expense that is not directly, has to be directly related to a business activity to be deductible is the charitable contribution deduction. So that now comes on the 990T after sort of the net unrelated business income from all trade or business activities has been calculated. So the next kind of big thing that we have to talk about is the treatment of net operating losses. And so there are some changes relating to that from the Tax Cuts and Jobs Act, the CARES Act, as well as the final regulations under 512. So the first kind of refresher on what the changes are is that for net operating losses generated in tax years beginning after 12/31/17, that the deduction will be limited to 80% of taxable income. The other thing to keep in mind is that for net operating losses generated in tax years ending after 12/31/17, net operating losses will be carried forward indefinitely. And the old rule was that first they would be carried back 2 years and then forward for 20. So the new rule is they're not carried back, but they're carried forward in perpetuity. That's the TCJA change. Then we get to the CARES Act, which in an effort to provide relief to organizations, provided that net operating losses generated in tax years beginning after 12/31/17, but before January 1, 2021, would now be eligible for a 5-year carryback period. So for those organizations that had income in a 5-year carryback period, they can now take advantage of the ability to carry back the loss and get a tax refund. So like the old rules, an organization that does not want to use the carryback, maybe because there was minimal income in previous years and it's not worth the effort to amend the return, will have to file an affirmative election to waive the carryback period no later than the first tax return due after the date of enactment of the CARES Act, which generally will be the 2020 tax return. So again, any net operating losses that are remaining either after the carryback period or because you choose to waive the carryback period will begin to be subject to the 80% limitation in 2021 tax years and forward, unless there is additional relief provided. So another important piece to understand with respect to NOLs is the ordering of them. because now we have the old net operating losses, the pre-2018 ones, which can go against any type of unrelated business taxable income and would not be subject to an 80% limitation. And then we have the newer net operating losses. And the return itself was kind of confusing in the way this is presented, because when you start reporting the information on a trade or business activity level, you see the place to take the deduction for these post-2017 net operating losses. And it's not until you get back to the core form 990T and have tallied up your unrelated, your sort of net income, only looking at positive income from your separate trade or business activities, that you then see the deduction for the pre-2018 net operating losses. So the regulations clarify that there has not been any change to the ordering of net operating losses, meaning that we continue to always take the oldest net operating losses first, but that you, in determining how much of your post-2017 net operating loss by trade or business activity is available after using the pre-2018 net operating losses, you can allocate those older net operating losses in the manner which would result in you being able to take the maximum available of your post-2017 net operating loss. So, for example, if you would be better off by using all of your older net operating loss against a single trade or business activity, so that you would then be able to use newer net operating losses that were in another trade or business activity against that income, then you can choose to do that. So it is a little confusing in that it doesn't tell you specifically what to do. It does allow for a lot of flexibility in permitting an organization to take those losses in the way that will allow them to use as much of the losses as possible. So some other net operating loss issues to consider are what happens when an organization terminates or completely disposes of a business activity. So the regulations provide that the net operating losses in that case will be suspended, but can be sort of used and revived in the future if the same activity is resumed, or if you start a new activity that uses the same 2-digit NAICS code. So that's good news in that it doesn't completely go away, but bad news in that you might need to track something in perpetuity in case it might ever be useful. The other situation that could come up is, what if you have a change to the business activity that you've been reporting? You change the 2-digit code. So there, the treatment depends on what caused the change and whether the change affects the entire business activity. So if the change applies to the entire business, meaning that you're using a completely different 2-digit code, then it's suspended, similar to the sort of termination example. But if only part of the business is changed, maybe you expand part of it, part of the activity, and it fits under a different 2-digit NAICS code, then you sort of spin off that activity, and no, sort of historical net operating loss gets allocated to that new activity, but it does remain with the existing activity. And also, if the change is not really due to a change in the underlying activity, but perhaps the interpretation of which 2-digit code was most appropriate for the activity, then the net operating loss stays with the activity. If you're just sort of correcting the classification of the activity and it hasn't actually changed. All right, so let's go to our second polling question, which is, how do you feel about the recent changes affecting UBTI reporting and treatment of net operating losses? Do you think it's great? It'll be helpful? It's terrible? You're likely going to pay more for compliance and taxes? It's fine? Or not applicable? My organization doesn't have UBTI. Well, that's good. So we've got the majority of people saying either it's fine, you won't be affected much, or it's not applicable, you don't have unrelated business taxable income. All right, so now we're going to be moving past unrelated business income, and we're going to touch on the new tax on excess compensation as we receive some proposed regulations on this new tax. So 4960 was added by the Tax Cuts and Jobs Act, and it imposes an excise tax on either the amount of remuneration in excess of $1 million and any excess parachute payment paid by an applicable tax-exempt organization to a covered employee. So notice 2019-19 provided some transition rules and interim guidance on this new tax. So it's important to know what are applicable tax-exempt organizations, and those include those that are exempt from taxation under Section 501A, which includes 501c organizations, as well as organizations that have income excluded from taxation under Section 115(1), which is related to providing governmental type services. So there was a lot of confusion around who was going to be subject to this new tax because of this definition of applicable tax-exempt organizations. But as we will see when we progress, other organizations can potentially be subject to the tax by virtue of their relationship to an applicable tax-exempt organization. So remuneration for the purpose of this tax generally means wages, but it does exclude Roth contributions and include gross income under Section 457F, which relates to certain deferred compensation plans. It doesn't include amounts paid to a licensed medical professional, including a veterinarian, which is for the performance of medical or veterinary services. It does also include remuneration paid with respect to employment of such employee by any related person or governmental entity. So this is how we begin to include organizations other than the applicable tax-exempt organization. So related organizations include any organization that either controls or is controlled by the organization, is controlled by one or more persons which control the organization, is a supported organization during the year with respect to the organization, or is a supporting organization with respect to the organization, or in the case of a voluntary employee benefit association, establishes, maintains, or makes contributions to the VEBA. So a covered employee, and that's another very important piece of the puzzle, includes an employee of the applicable tax-exempt organization, which is either one of the 5 highest compensated employees of the organization for the tax year, or was a covered employee of the organization or any predecessor for any preceding taxable year beginning after December 31st, 2016. So the regulations clarify that there will be no provision for an employee to ever stop being a covered employee. So each year an applicable tax-exempt organization is going to have to determine who its 5 highest compensated employees are for that year, but also be rolling forward that list of employees that were considered to be one of the 5 highest compensated employees in a previous tax year. So if we have a group of related organizations, the regulations also clarify that each organization has to determine its 5 highest compensated employees on a standalone basis. Therefore, in looking at the entire group, it's possible that there may be more than 5 highest paid employees in total, since each organization will be determining its list separately. So there were some concerns about situations where, for example, a for-profit company might be related to an applicable tax-exempt organization, either by virtue of having, representation on the board of that nonprofit organization because of their title with the for-profit organization. So the proposed regulations provide a number of exceptions that will provide for situations where compensation paid by a related entity that doesn't relate to the services that that individual is providing to the nonprofit organization will not have to be taken into account. So the first is a limited hours exception. So if the applicable exempt organization nor any related organization provided remuneration to the individual for services performed as an employee of the ATEO, and they performed services as an employee of the ATEO and all related ATEOs for no more than 10% of the total hours they worked as an employee, then that will qualify for the exception. So we've got some facts and conclusions so you could see how this might apply. In the interest of time, we're not going to go through each example, but you can kind of see how or whether these exceptions might be applicable to your organization. The next exception is the non-exempt funds exception. And so it's very similar to the limited services exception, except this one is kind of focused on whether whether the related organization that did pay an individual is getting a fee from the applicable tax-exempt organization for such services. So again, if that fee is not paid and you meet sort of the hour commitments, then again, there could be provision for excluding compensation paid by a related organization. The last exception is the limited services exception. So this is looking at where you might have an individual that provides services across multiple related organizations. And so if they're providing only minimal services to one of the organizations and there is another organization that is basically providing most of the remuneration, then again, that person can be excluded on the organization for which they're providing them limited services. All right, so that brings us to polling question number 3. Why do you think the new tax on excess compensation was created? To discourage not-for-profits from providing high compensation packages to their employees, to raise tax revenue, to offset tax cuts provided in other areas, to provide parity between NFPs and for-profits with respect to compensation, or who knows? So as those answers are coming in, the data for the first sort of batch of Form 4720s that were filed to report this new tax showed $125 million in taxes related to excess compensation. And just to sort of give comparison, all other excise taxes reported on Forms 4720 for the same period only totaled $14 million. So it looks like it's pretty evenly split between the first 3 categories. Honestly, I'm sure there's probably more than one reason why anything ever happens, but you can see that definitely they have been able to raise a lot of tax revenue, at least so far. Okay, so let's bring us to closing that out, and we will move on. Again, this new tax on certain institutions' net investment income does not affect a great number of institutions, but we just wanted to touch base on it because I know there have been some concerns that this could potentially be a sign of expansion in this area. And so this new tax is on the net investment income of certain private colleges and universities, and we did see final regulations issued in September. And so the positive items related to that sort of provided some exceptions to the inclusion in net investment income of certain types of income that are related to the institution's exempt activities, like interest on student loans, rental from student housing. So all of that can be excluded from the calculation. And then also, if there's capital gain from the disposition of property used as part of the institution's exempt activities, that would similarly be excluded from net investment income. So let's talk a little bit about the IRS's compliance program and accomplishments. So it's been pretty steady. Here's a snapshot of the tax-exempt government entities group. So the tax-exempt group has a staff of about 1,500 individuals, approximately a third of which are focused on exempt organizations. So the organizations that are to be basically subject to oversight by this group, the exempt organization groups. They employ almost 25% of the US workforce, control over $31 trillion in assets, and account for 20% of 1.3 trillion in federal tax expenditures. So this is a very large sector, and we have a small staff to oversee the sector. So it's always kind of important to keep that in mind. So in looking at the size of that sector, but also in looking at the number of staff, you can see that only about 3,800 examinations were started during the year, and about 3,700 exams were closed. So not a lot of examination activity going on with respect to sort of the overall size of the sector. And of those exams, only about 60 revocations were proposed, with the most common reason being not operating for an exempt purpose. Given the limited staff, the IRS is focusing on data-driven examinations, meaning that they're pulling information reported on payroll returns, Form 990, 990T, and using the information from those returns to sort of come up with a matrix of items that might reflect potential non-compliance. So their top issues are employee classification, unreported compensation, unrelated business income, and excise taxes. And out of their examinations, only about 37% resulted in a change. Determinations, that's the group that approves new applications for exempt status. This is a very high volume area, as you can see. They had to process about 100,000 applications in a year, the vast majority of which were approved. Compliance checks. So this is a little bit less than an examination, but this is where they'll be looking at sort of things that should match up and contacting the taxpayer if things are indicating that something is wrong. So not filing a 1099 miscellaneous, having discrepancies between W-2s and 941s. Information letters were sent to organizations that they thought might potentially be subject to the new excise tax on excess compensation. You see a lot of payroll related issues here. That's kind of a theme. Going forward, there will continue to be a focus on private benefit and enormment, looking at 990Ts where expenses materially exceed income, compliance with backup withholding requirements for payments to independent contractors, and continuing to revise sort of those matrices that are identifying red flags on a 990 or 990T that might indicate that an organization is at great risk for noncompliance and therefore should be looked at further. Some other developments, there's been a big overhaul to the group exemption process. So currently there are about 4,000 group exemption letters, which cover 440,000 subordinate organizations. So what that means is that basically they approved 4,000 individual applications instead of 440,000. So it's a really important process, but it hasn't been updated in a long time. So right now, group exemption requests are on hold until the guidance is finalized. So some of the proposed changes include having a minimum requirement for having at least 5 subordinate organizations to be able to apply for a letter, and allowing only 1 group exemption per central organization. So the changes listed here are focused on trying to make the process a little bit more administrable for the IRS. Right now, they're struggling with sort of inconsistencies between group types and reporting, and so they're trying to make it a little bit more streamlined. Another thing to keep our eye on is the mandatory e-filing of returns. So probably most of you are familiar with filing your 990 electronically, but now the Form 990T is going to be required to be filed electronically. Because it hasn't even been available to be filed electronically, we're anticipating that there could be some difficulty in the beginning, sort of working with software providers and the IRS to make sure that this is able to kind of happen seamlessly. I think we may see a delay if there's any trouble in sort of getting these systems up and running. But otherwise, we should expect for 2020 tax years and forward that the 990T will need to be electronically filed. So I wanted to just bring one private letter ruling to your attention. So typically, organizations, that have related entities may institute a system where one entity is the employer of all individuals, and basically that employer may provide services or share those employees with other related entities, and then just get reimbursed for those services. So in this case, there was a nonprofit healthcare system that had a wholly owned for-profit subsidiary that was operating a political action committee. And the taxpayer, which was the nonprofit, provided services and resources to the subsidiary and PAC under a contractual agreement. The IRS essentially said that providing those services, even though they were reimbursed, essentially meant that the nonprofit was deemed to be engaging in those activities, which, being political activities, are not permissible for a 501c3 organization to conduct. So a lot of people were concerned about this. I think it reminds us that the IRS's preference with respect to reimbursement arrangements is that the exempt organization, the 501c3, should reimburse a for-profit entity for the use of its employees, rather than the converse situation being true. And lastly, just want to remind everyone that there are some amazing incentives due to the CARES Act for charitable contributions for 2020, in that cash contributions to public charities other than donor advised funds and supporting organizations could potentially be deducted up to 100% of adjusted gross income for an individual. And corporations, their cap could be up to 25% instead of 10%. And there's also an above the line charitable deduction of $300 that's available to individuals that don't itemize deductions. All right, so I think I'm a couple minutes over, so let's bring us to our very last poll question. Which area of tax compliance concerns you the most with respect to your organization? Employment taxes, unrelated business income taxes, revocation of exempt status, or all of the above? So as our sort of venture through the IRS's compliance program probably showed you, employment taxes are paramount in their mind. That's the area they're typically focused on, even in connection with exempt organization. So those of you that answered employment taxes, that's probably a safe bet, although potentially any of the issues could be of concern. Okay, everyone, please get your votes in. And I know that doesn't really bring us any time for questions, but I don't see any in the questions pod. So hopefully we addressed everything you had today. And if not, please feel free to reach out to me anytime. I'd love to hear from you.
Thank you so much, Amanda. Really appreciate it. And we've got our last session starting in just about 7 or 8 minutes here. So invite everyone to log out of this GoToMeeting and go back to the agenda and click on that unique link for the last session of the seminar. And with that, we thank you, Amanda. Appreciate it, and look forward to seeing everyone for the last session.